although China wasn't the biggest buyer of gold last year, I think Poland was, people are taking their lead from China, who in the month of December bought twice as much gold as they bought in November. In November, they had, that was after a several month break when they hadn't bought any gold. The increase in China's reserves over the last 12 months, 80% of that increase has come from gold itself, a mixture of buying gold and the rise in the gold price. Now, what that's saying, China is buying gold, and gold's at an all-time record. They are valuing gold more than any other asset they could buy. That's why the gold price is rising, despite the fact that interest rates are going up, despite the fact we've had de-escalation to some extent in the Middle East.
China has significantly increased its gold reserves, with 80% of its reserve growth over the past year attributed to gold purchases and price appreciation. China doubled its gold purchases in December alone compared to November, following a brief pause in acquisitions. This trend highlights China's prioritization of gold as a key asset, even as prices reach record highs. Notably, gold's value continues to rise despite higher interest rates and some easing geopolitical tensions in the Middle East, reflecting its enduring appeal as a strategic reserve asset. A well-known Canadian journalist, author, and speaker, Clive Thompson, explains that short-term interest rates, like the Fed funds rate, have decreased by 1% over the past 6 months, while long-term rates, like the 10-year Treasury yield, have risen by 1%. This divergence stems from rising government borrowing needs, driven by higher debt costs and expanding budget deficits with no immediate plans to address them. Investors demand higher yields, but as rates rise, the government borrowing cost could become unsustainable, potentially triggering a rapid decline in bond values. Clive highlights that the Federal Reserve may buy Treasury bonds from primary dealers to prevent this, effectively printing money to expand its balance sheet. This intervention would suppress bond yields and inject significant cash into the system. The influx of money flows into tangible assets rather than back into Treasury bonds as investors seek higher returns, exacerbating inflationary pressures and impacting asset markets. Check out the video for more details, and if you enjoy the content, please like and subscribe for the latest updates.
Well, yeah, in simple terms, the short-term rates, the overnight rate or the Fed funds rate, is down by 1% in the last 6 months. And the long-term rate, the 10-year rate, is up by 1%. So we've had the two rates move in completely opposite directions. And the reason why that's happening is I think people are saying there is this huge borrowing requirement which is happening, partly due to the rising interest costs of the debt and partly due to the expanded budget deficit. No real plans to address it at the moment. They may come, but they're not there yet. If this continues, investors like me are going to get indigestion because I can't afford to buy any more Treasury bonds. At least I'm not going to buy them at 4.5% anymore. I need 5% or 5.5%. Now, there will come a point when that interest rate, which the government would have to pay to borrow money, will be unpalatable for the government because it will be accelerating the spiral out of control instead of a slow, painful death in the value of government bonds. It could spiral into a very rapid decline. So before we get there, and we won't get there, but before we get there, the Federal Reserve will be asked or invited or instructed or ordered, or will just decide on its own to step in and start to buy the bonds from the primary dealers, which the government is selling the Treasury bonds to the primary dealers to raise cash. The primary dealers will be selling them to the Federal Reserve, and the Federal Reserve will be expanding its balance sheet because where's it going to get the cash to buy those bonds? Well, the way it's always got the cash in the banking crisis and the COVID pandemic, and the way it will do it next time, which is coming soon, they will print money. So what we'll see is an expansion of the money supply as the Fed prints money to buy those bonds, and they'll be buying the bonds to stop the interest rate or stop the yield of those bonds rising beyond a certain point. And of course, we all know what that will mean. It'll mean a lot of cash entering the system, and someone somewhere is getting all that cash, and what are they going to do with it? Well, they're going to buy tangible assets. They're not going to put it back into Treasury bonds unless they think the interest rate is high enough. But the interest rate won't be high enough because it's been suppressed by the Federal Reserve.
The speaker, Clive Thompson, anticipates a potential financial intervention by the Federal Reserve in 2024, with some commentators predicting action as early as the first or second quarter. They believe the Fed will step in when interest rates approach a critical threshold, likely between 5% and 6%. If rates climb to 6% without intervention, the Fed may be compelled to act to prevent economic instability. Quantitative easing could stabilize long-term rates by purchasing government bonds and injecting liquidity into the system. Clive talks about recent U.S. inflation data, which has renewed discussions about possible interest rate cuts this year, with 2 cuts now back on the table. While the Fed directly controls short-term rates, it can only influence long-term rates through quantitative easing. Given favorable inflation figures, the Fed may reduce rates while conditions allow, though the extent of cuts remains uncertain, with 1 or 2 reductions being plausible scenarios. Now, let's get back to the interview.
I'm seeing the third quarter of this year, and I'm perhaps a bit late on that because I see other commentators saying it could happen in the first or second quarter. Yes, it could. I kind of think things won't go quite that fast, but we are entering the danger zone as interest rates rise towards 5% and beyond. Where's the cutoff point? Where's the Fed step in? I think the rate is lying somewhere between 5 and 6%. Difficult to say. Is it 5.25, 5.5, or is it 6? But are we on our way to 6%? I think if the Fed doesn't step in, yes.
Now, when it comes to interest rates, though, so with quantitative easing, it's often the Federal Reserve creating currency and pushing it into the system. But do you actually see the Fed reducing interest rates significantly more?
Well, sentiment has been swinging 2 ways or 3 ways, I suppose, in the last few weeks. When they last cut interest rates in December, the view was we'd get 2 more cuts this year. Then as the bond yield started to rise, sentiment started to change, and actually there was some words coming out of Fed saying we're not in such a great hurry to cut rates. So sentiment started to change a little bit along the lines of it might take longer before they cut them, and we might not even get those 2 cuts. But recently, just last day or 2, we've had some very good inflation numbers in the United States, and the 2 cuts this year are back on the table. Of course, the Fed can do what it likes at the short end. It can, that's what it controls. It doesn't control the long end unless it steps in with quantitative easing, buying government bonds. So really, the short-term interest rate is what's under the control of the Fed. If they want to reduce it now, they can. They've got full justification for doing so on the grounds of those recent inflation numbers. So I think it's likely they will while they can, but whether it be 1 or 2 cuts.
China's significant gold purchases underscore its strategic shift toward tangible assets amid global economic uncertainties, while the U.S. faces challenges balancing rising interest rates, government borrowing, and inflation. The Federal Reserve's potential interventions, including quantitative easing and rate cuts, highlight the precarious nature of managing economic stability in the face of mounting fiscal pressures and market demands. How might China's growing gold reserves influence global monetary policies and the role of the U.S. dollar as a reserve currency? What are the potential long-term consequences of the Federal Reserve's reliance on quantitative easing to manage rising interest rates and government borrowing? Share your thoughts in the comments below. We'd love to hear from you. If you found this helpful video, don't forget to give it a thumbs up and subscribe for more content. Thanks for being a part of our journey.